Episode 8: The Power of Compounding and Dividend Reinvestment. Part 1: Understanding the True Force of Compounding. Albert Einstein allegedly called compounding the eighth wonder of the world. Whether or not he said it, the truth remains: compounding is one of the most powerful forces in finance. At its core, compounding is earning returns on both your original investment and the returns it's already generated. Over time, this snowball effect becomes exponential, not linear. The difference between linear and exponential growth. Let's compare. Linear growth. You earn $1,000 a year on a $10,000 investment. After 10 years, you have $20,000. Exponential growth, compounding. You earn 7% annually and reinvest the returns. After 10 years, you have about $19,672, but after 30 years, you have more than $76,000. The later years explode in growth because each year's gains start earning gains of their own. Why time is your best ally? Compounding is heavily time-dependent. The earlier you start, the less you need to contribute to reach big goals. Example. Investor A starts at age 25, invests $300 per month at 7% until age 65, right pointing arrow tilde $725,000. Investor B starts at age 35, invests $300 per month at 7% until age 65, right pointing arrow tilde $339,000. Those 10 extra years nearly double the final amount without B ever catching up. The magic happens late. In the early years, compounding feels slow. In the final years, it explodes. That's why pulling money out too early, or stopping contributions, kills the effect. The last decade of a 40-year compounding journey can generate more than half of the total wealth. Patience is not optional, it's the whole point. Compounding plus reinvestment equals turbocharge. Reinvesting dividends is one of the easiest ways to make compounding even more powerful. Instead of taking cash payouts, reinvest them to buy more shares, which then earn their own dividends. Over decades, this can multiply returns. Dividend reinvestment strategies and historical impact. What is dividend reinvestment? Dividend reinvestment is simply taking the cash payments companies give you, usually quarterly, and using them to buy more shares instead of pocketing the money. Some investors set this up through DRIPs, dividend reinvestment plans, which automatically use your dividends to purchase additional shares, often without commissions. Why it works so well: reinvested dividends create a feedback loop. You buy more shares with dividends. Those new shares pay their own dividends. The process repeats and compounds year after year. This turns a steady stream of income into a growth engine. Historical proof of power. From 1973 to 2022, the S&P 500's price return averaged about 7.4% per year. But when you include reinvested dividends, the total return jumps to about 10.3% annually. That difference might sound small, but over 50 years, $10,000 grows to price only $350,000 price plus dividends reinvested $1,200,000. The gap is enormous because dividends compound on top of price gains. DRIPs versus manual reinvestment. Automatic DRIPs. Best for set it and forget it investors. No commissions, compounding without effort. Manual reinvestment lets you redirect dividends to other investments, but requires discipline and may incur fees. For most long-term investors, DRIPs are the simplest way to harness dividend compounding. International and sector examples. U.S. utilities often yield 3 to 5%, and reinvestment here has historically boosted total returns significantly. Emerging markets. Higher dividend yields can make reinvestment especially powerful if growth also holds. Rights. By law, they pay out 90% of income as dividends. Reinvesting these payouts can dramatically accelerate portfolio growth. The power of compounding and dividend reinvestment. Real-world compounding case studies. Case study 1: Early starter versus late starter. 2 investors. Same returns, same monthly contributions. Only one difference: when they start. Investor A starts at age 25, invests $300 per month at 7% annual return until age 65. Final portfolio: $725,000. Investor B starts at age 35, invests the same $300 per month at 7% until age 65. Final portfolio: $339,000. That 10-year head start means Investor A ends with more than double the wealth, even though B invested the same amount each month. Case study 2: Reinvesting dividends versus taking cash. If you invested $10,000 in the S&P 500 in 1980 and took dividends in cash, you'd have about $477,000 by 2023. If you reinvested those dividends, you'd have over $2 million. The reinvested portfolio grows faster because every dividend bought more shares, which then generated more dividends. Case study 3: The power of staying invested. The $100,000 portfolio earning 8% annually grows to about $466,000 in 20 years if left untouched. But if you withdraw just the dividends instead of reinvesting, the same portfolio only grows to around $310,000. Taking the income early slows compounding dramatically. The last decade effect. In long-term compounding, the last decade often contributes more growth than the first 2 decades combined. Example: $100,000 invested at 8% for 40 years grows to $2.17 million, but more than $1.1 million of that growth happens in the final 10 years. Why people miss out? The biggest reason people miss the compounding magic is interrupting the process by selling during market drops, withdrawing dividends too early, or delaying their start. Compounding rewards patience and punishes impatience. Strategies to maximize compounding. 1. Start immediately, even if it's small. The biggest lever you control is time in the market. A $100 monthly investment started at age 20 can grow larger than a $500 monthly investment started at age 35. Key takeaway: don't wait for the perfect time. The perfect time is now. 2. Reinvest all earnings. Whether it's dividends, interest, or capital gains distributions, reinvest them. The compounding machine only works at full power when all earnings stay in the system. 3. Keep costs low. High fees slow compounding like a leak in a bucket. A 1% annual fee on a $500,000 portfolio can cost you over $300,000 in lost growth over 30 years. Use low-cost index funds or ETFs with expense ratios under 0.10% when possible. 4. Minimize taxes on compounding. Taxes are compounding's enemy. Use tax-advantaged accounts, 401k, IRA, Roth IRA, to protect gains. In taxable accounts, consider tax-efficient funds and asset location to reduce tax drag. Avoid frequent trading. Holding for the long term keeps more money working for you. 5. Choose the right dividend stocks or funds. Look for companies or funds with a consistent track record of paying and growing dividends. Payout ratios below 60%, signaling room for increases. Solid financials and stable industries. Well-known examples include dividend aristocrats, companies with 25+ years of consecutive dividend increases. 6. Stay invested through market cycles. Pulling out during market downturns interrupts compounding and locks in losses. History shows that missing just the 10 best days in the market over 20 years can cut your returns in half. 7. Automate contributions and reinvestment. set up automatic deposits and drifts so compounding happens without relying on willpower. Automation removes the temptation to spend instead of invest. Mistakes that break compounding and how to avoid them. Mistake 1: interrupting the process. Compounding needs uninterrupted time to work. Selling during market downturns or withdrawing dividends too early resets the clock. Avoid it. Only invest money you can leave untouched for years, preferably decades. Mistake 2: chasing high yields without safety. A 10% dividend yield can be a red flag, often signaling financial trouble or an unsustainable payout. Avoid it. Focus on total return, dividends plus price appreciation, and the sustainability of payouts. Mistake 3: ignoring inflation. If your returns don't outpace inflation, your purchasing power shrinks even if the numbers grow. Avoid it. Target investments with long-term returns that beat inflation, like stocks and inflation-protected bonds. Mistake 4: overtrading. Frequent buying and selling can rack up commissions, taxes, and missed growth opportunities. Avoid it. Stick to a disciplined buy and hold approach, rebalancing periodically rather than constantly tinkering. Mistake 5: letting fees compound against you. Just as your returns can compound for you, fees can compound against you over time. Avoid it. Choose funds with low expense ratios and avoid unnecessary advisory fees unless they deliver measurable value. Mistake 6: neglecting dividend growth. A stock that pays a high yield today but doesn't grow its dividend may underperform a lower yielding stock with consistent increases. Avoid it. Look for companies with a proven history of raising dividends year after year. The core rule. Think of compounding as a fragile engine that becomes more powerful every year, but only if you keep it running without interruption. Every withdrawal, high fee, or poor decision is like pulling parts out of that engine. Compounding action plan and final takeaways. Step 1: start now. Even small amounts grow significantly over decades. Waiting even a few years can cost you hundreds of thousands in lost growth. Step 2: reinvest everything. Automatically reinvest dividends, interest, and capital gains to maximize compounding power. Step 3: automate your contributions. Set up recurring deposits into your investment accounts so contributions happen without hesitation. Step 4: keep costs and taxes low. Use low-cost index funds or ETFs. Hold investments long-term to reduce taxes. Place high-yield or high-turnover investments in tax-advantaged accounts when possible. Step 5: select quality dividend growers. Prioritize companies or funds with a long history of paying and increasing dividends. Stability and growth beat flashy short-term yields. Step 6: stay the course through volatility. Market dips are opportunities for compounding to work harder. Don't interrupt the process by panic selling. Step 7: review annually. Adjust when needed. Confirm your investments still align with your goals, but avoid frequent changes that disrupt compounding. Final perspective. Compounding is simple in theory but challenging in practice because it requires patience, consistency, and discipline. The formula for long-term wealth is straightforward. Start early, reinvest diligently, keep costs low, and let time do the heavy lifting. When combined with dividend reinvestment, compounding can turn modest contributions into life-changing sums. The earlier you begin, and the longer you stick with it, the greater the reward.